There's one thing I've learned after years of watching the US financial markets. Sometimes the most dangerous investments aren't the ones that look obviously risky. They're the ones that make us feel too certain. When a stock rises sharply, when a fund pays an extremely high dividend, or when a company keeps buying Bitcoin, it's very easy to look at those numbers and think, we understand the whole story. But financial markets are rarely that simple. And that's exactly why today I want to take a deeper look at strategy, or the stock many people still know as MSTR, as well as MST, a product built around the MSTR and Bitcoin ecosystem. If you've been following these investments, you may have heard some news that disappointed many investors. MST reduced its distribution from 10 cents to 7.5 cents. At first glance, that clearly doesn't sound like good news. A 25% reduction naturally makes income-focused investors ask, is something wrong with the strategy? Was the previous yield simply too high to be sustainable? Or is this a sign that Bitcoin and MSTR are losing some of their appeal? But when it comes to investing, sometimes the most important question isn't, how much did the number decline? The better question is, why did it decline? And even more importantly, could today's reduction actually make the asset stronger in the future? That distinction is huge. Imagine you own a small business. The business is paying you almost all of its profits every month. That sounds great. But if the business has to sacrifice cash, expansion opportunities, and future growth just to maintain those payments, you may eventually realize that you're receiving a lot of money today while giving up too much value tomorrow. Markets can work the same way. An extremely high yield does not automatically mean an investment is good. Sometimes an unusually high yield can actually be a warning that the strategy is doing too much just to maintain that level of income. And that's the point I want you to pay attention to when looking at MST. When the distribution was 10 cents, MST's yield became extremely high at certain points. And to generate that level of income, the fund uses covered calls. Covered calls can be a very useful tool for generating income from an asset you already own, but they come with a trade-off. You collect premium today, but in exchange, you may have to give up some upside if the underlying asset rises too quickly. Now put that into the current environment. If Bitcoin enters a period of strong growth, do you really want a strategy that continuously sells away too much of MSTR's upside? Maybe not. So reducing the distribution from 10 cents to 7.5 cents may look like a step backward from an income perspective. But from another perspective, it could be a way to create more room for growth. And this is one of the most important principles in investing that I want you to remember. Income and growth don't always move together. Sometimes, in order to preserve an asset's ability to grow in the future, you have to accept less cash today. That's something many investors overlook. They see a massive dividend yield and assume they're winning. But an experienced investor asks a different question. What will my total return be after 3 years, 5 years, or 10 years? Because ultimately, we don't invest simply to watch distributions appear in our accounts. We invest to build wealth. And that's also why we need to look deeper into strategy. Because the MSTR story isn't simply a story about a stock. It's a story about Bitcoin. It's a story about leverage. It's a story about preferred shares. It's a story about debt, cash, dilution, and the ability to raise capital. And above all, it's a story about how a company can use its capital structure as a tool to amplify its exposure to Bitcoin. There's one particular metric that I believe every MSTR investor should understand, and that's net reserve. Because when you only look at the total amount of Bitcoin strategy owns, you're seeing only half of the story. You need to ask, after accounting for debt obligations and preferred shares, how much value actually remains for holders of MSTR common stock? And when Bitcoin rises, that remaining value can potentially increase faster than the amount of Bitcoin on the balance sheet. That's where the amplification effect begins to appear. But remember one thing, in finance, every form of leverage has two sides. If Bitcoin rises, MSTR can potentially benefit tremendously. But if Bitcoin falls, that same mechanism can cause MSTR to decline much more sharply. And that's why the most important question isn't, will Bitcoin go up or down next week? Nobody truly knows. The more important question is, if I'm right, how much could I make? And if I'm wrong, how much could I lose? That's how a mature investor looks at the market. And in the next part, we'll take a deeper look at something that may be even more important than MST's dividend. what Strategy is doing with billions of dollars in cash, why the company is buying back STRC below par, and how MNAV could determine when Strategy should issue shares or buy back its own stock. Because behind those seemingly dry numbers is a much bigger story. Strategy is trying to build a capital machine around Bitcoin, and the way that machine operates could determine how much value MSTR shareholders receive over the years ahead. Now let's go deeper into what many investors overlook when they look at MSTR. If you only watch Bitcoin's price, MSTR's stock price, or the dividends paid by MSTR-related products, you're seeing only the tip of the iceberg. The real story is the capital structure. Strategy isn't simply buying Bitcoin and waiting for it to rise. It is building a system of common stock, preferred shares, debt, cash, and Bitcoin. And each component affects the value ultimately belonging to MSTR common shareholders. That's why I want you to pay attention to a recent move. Strategy has built approximately 1.59 billion US dollars in USD cash, while increasing its USD reserve to roughly $5.1 billion. According to a filing released on August 24th, this additional cash could be used for treasury activities, including buying Bitcoin or repurchasing Strategy securities. Reuters. Pause on that $1.59 billion. That isn't pocket change. More importantly, Strategy is no longer relying on a single assumption. If Bitcoin goes up, we win. Instead, it is trying to build a balance sheet flexible enough to operate under different market conditions. If Bitcoin falls sharply, cash provides more time. If STRC trades below par, Strategy can potentially buy it back. If MSTR trades at an attractive valuation, the company can consider repurchasing shares. And when market conditions are favorable, capital raised can continue supporting its Bitcoin strategy. That's capital flexibility. In financial markets, flexibility can sometimes be more valuable than correctly predicting where the market goes tomorrow. Imagine a family with $100,000 in assets. If all $100,000 is invested in one asset, they can make a lot if it rises, but they have few options if it falls. A family with $70,000 invested and $30,000 in cash may earn less during a strong bull market. But when prices fall, they have something the first family doesn't. Options. They can wait, buy, restructure, or take advantage of opportunities. That's the role cash can play in Strategy's capital structure. But another piece is even more interesting, STRC. Strategy has said it wants STRC to trade back toward its $100 par value. And if STRC trades below $100, the company may repurchase it in a disciplined manner depending on price and liquidity. In its Q2 report, Strategy also said it had repurchased STRC at a discount to par. SEC. A new investor might simply say, Strategy is buying back its own preferred shares. But an experienced investor asks, why? The answer is economics. If a preferred share has a $100 par value but can be repurchased for less than $100, Strategy may reduce future capital obligations at a cost below par. If a $100 obligation can be bought back for $97, theoretically the company is resolving a $100 obligation by spending less than $100. And if that preferred security carries a dividend obligation, repurchasing it can also reduce future dividend obligations. So don't focus only on, Strategy didn't buy more Bitcoin this week. Not buying Bitcoin doesn't necessarily mean the company is standing still. It may be improving its capital structure. And a stronger capital structure today can create more options tomorrow. That's why MNAV matters. Imagine a $500,000 house. If a bank values it at $500,000, your financing options are very different from a situation where the same house is valued at family situation, a different set of opportunities, different valuation. What matters isn't where you are today. The same principle applies to MSTR. When MSTR trades at a significant premium to its underlying asset value, issuing additional shares can become a powerful capital-raising tool. But if MSTR trades below intrinsic value, the equation changes. Issuing shares may become less attractive, while buying them back could become more logical. That's why I view MNAV as a kind of control valve for Strategy's capital machine. It can help determine whether capital should flow into the company towards security repurchases, remain as cash, or be converted into Bitcoin. And that brings us to a word many MSTR investors fear: dilution. Strategy has raised substantial capital through common stock and other securities. According to its Q2 report, the company had raised approximately $17.06 billion through ATM programs during 2026 through the end of July. SEC. The obvious concern is, the more shares Strategy issues, the more existing shareholders are diluted. Mechanically, that concern is reasonable, but dilution isn't automatically bad. The key question is, what does the company receive in exchange for those new shares? If shares are issued to acquire assets of comparable value or create additional value per share, the impact can be very different from issuing shares simply to plug a financial hole. That's why investors shouldn't only ask, how many shares are outstanding? Ask, after all these capital structure changes, how much Bitcoin exposure and net asset value am I actually getting per MSTR share? That is the real question, because ultimately, we don't own a number called a Bitcoin reserve. We own a piece of a capital structure, and that piece can change over time. It can increase if Bitcoin rises, decrease if Bitcoin falls, and be affected by preferred shares, debt, additional share issuance, or repurchases of securities trading below fair value. That's why MSTR shouldn't be viewed like a typical technology stock. It's more like a financial structure built around Bitcoin. And every investor needs to accept one reality: MSTR is not a simple investment. It can deliver significant upside if Bitcoin rises sharply and the capital structure works in favor of common shareholders. But it can also produce painful declines if Bitcoin moves the other way. That's the other side of leverage. Leverage doesn't create magic. It simply makes the outcome larger. If you're right, it can help you move faster. If you're wrong, it can make you lose money faster. So the most important question isn't, will MSTR go up? It's, do I actually understand what I own? If the answer is yes, you'll look at MSTR very differently from someone who only watches the price chart. You'll examine the Bitcoin reserve, net reserve, preferred shares, debt, cash, MNAV, and most importantly, the amount of Bitcoin value actually attributable to each MSTR common share. Because market sentiment can change every day. A stock can move 5%, 10%, or more. But intrinsic value doesn't automatically change simply because sentiment shifts during one afternoon. That's where long-term investors can find perspective. Not by predicting the future, but by understanding what they own. And in the final part, we'll bring everything together: MSTR, MST, Bitcoin, net reserve, and the amplification effect, to see why the same move in Bitcoin can produce very different outcomes for different types of investors. Now we have enough pieces to see the bigger picture. We've talked about MST reducing its distribution from 10 cents to 7.5 cents. We've talked about the cash Strategy is building. We've talked about STRC, preferred shares, MNAV, and the issue of dilution. But ultimately, all of this brings us back to one very simple question. If Bitcoin truly enters a powerful bull cycle, what could happen to MSTR and MST? And on the other hand, what happens if Bitcoin falls sharply? This is the part I believe every investor needs to understand before putting money into highly volatile assets like these. Let's start with the simplest scenario. If Bitcoin rises, the value of the Bitcoin strategy holds a different set of opportunities. That sounds obvious. What matters isn't where you are today. The story doesn't end there. What matters is whether you choose to start building your future today. It also has debt. You don't need to invest tens of thousands of dollars over common shares outstanding. You don't need to become a stock market expert. And you certainly don't need to predict where the economy will be next year. What you need is a clear plan, a consistent investment strategy, and enough patience to let time do the rest. Because real wealth is rarely created overnight. It's built through smart. You still have a $700,000 mortgage. That means your actual equity is only $300,000. Now, suppose the house rises to $1.1 million. The underlying asset increased by 10%, but your equity increased from $300,000 to $400,000. That's an increase of more than 33%. The house didn't need to rise 33%. The underlying asset only had to rise 10% for your equity to increase much faster because the debt remained relatively fixed. That's a very simple way to understand leverage. And it's also why MSTR can become extremely attractive during a Bitcoin bull market. But remember, the same math works in reverse. If the house falls from $1 million to $900,000, your equity could fall from $300,000 to $200,000. The asset falls 10%, but your equity falls by more than 33%. That's why I always say leverage isn't inherently good or bad. Leverage simply amplifies the outcome. And with MSTR, Bitcoin is the biggest variable in that equation. Now let's turn to MST. MST has a different structure. It seeks to generate income through covered calls while maintaining exposure to MSTR and using leverage. That's a difficult balance to maintain because if you want very high income, you may need to sell more covered calls.